Hey guys, welcome back once more. So thank you very much for liking, subscribing, and commenting on my other videos. If you have not watched my other videos, I recommend you do watch them because I like to share all my strategies that I'm doing to kind of grow my account slowly but surely. Now I say slowly but surely because I tend to do a lot of covered calls and selling puts. I don't really do the riskier trades as much all the time. Once in a while I will buy some options. Options, it's a great way to kind of grow your account real quick. But then again, your money can disappear just like that too when you're buying options. Now, if you want to slowly but surely grow your account in a safer kind of way, then I recommend you watch my videos because that's usually what I do. And I like to share my strategies the way I do it. I'm not telling you, hey, you got to buy this stock or go, do it on this stock. No, I mean, there's a bunch of stocks out there. Just pick the right one for you that you like, that you're okay with holding for the longer term, because each stock, it's going to have its red days, its green days, or days where it just doesn't do anything at all. And you know what? Another thing I wanted to do is shout out to my girl Anai from Mexico. So I told her I was going to give her a shout out. I forgot to do it at the beginning of the video. But here's your shout out, Anai. Anyway, moving forward, if you have a small account and you're trying to grow it slowly but surely, then selling covered calls and selling puts, it's a great strategy that you might want to implement in your strategy. Of course, there's other strategies, like I said, day trading penny stocks, buying options. There's a bunch of strategies that you can make a lot more money fairly quickly. But I'm going to show you the safer way, in my opinion. Okay, so I'm going to give you a few examples with the stocks that I'm doing them on. And again, you can pick any stock. You don't have to buy these. I'm just doing them on these because I understand the risks of doing them. So a Neo, for example, it's a very cheap stock, but it has some pretty good premium because of the high volume on Neo. So I tend to do at the money covered calls on Neo. I don't really sell any puts on Neo. And I'll give you an example on what I did with Neo. So yesterday, I bought 300 shares. I have an average price of $2.51. So that's how much I paid, and that I have 300 shares of them. So remember, per contract, for each covered call, you have to have at least 100 shares of the stock. And I sold at the money covered calls. Now, NEO has earnings coming up tomorrow. And, most people don't play the earnings, so there's a big sell off. So, I figured there was going to be some sell off before earnings. And that's exactly what happened. So, yesterday, I ended up selling. Well, it's not going to show you the history from yesterday here, but I ended up getting 9, 10, and then 11. Yeah, so 9, 10, 11 in premium from 3 contracts. So that's about $30 that I got yesterday for selling at the money covered calls at NEO for $2.50. So $30, and today the price of NEO just dropped. And what happens when the price of the stock drops? So basically those contracts, they become a lot cheaper. So you can buy them back, removing your obligation, and then do another covered call. So basically I already bought them back, and you can see right here, bought 3 NEO 100 weeklies 6 December. So these would basically expire tomorrow. So this is how much I got, $30 for just one day. That's how much premium NEO had. Then, I collected $30 for a $2.50 call. And today I bought those options back. I bought them, removing my obligation to sell NEO for 3 cents, basically $3 each contract. So I paid $9 to buy the options back, removing my obligation once again. So now I can write another covered call. So I got $30, and then I used those $30 to buy the options back at $9. So I kept the difference. So I made $20. I'm give or take a few, of course. Now what we can do is sell another covered call. Again, you're down on the capital gains, yes. But if you were to simply just buy the stock, you would just be down on it. You wouldn't be making any money. The only money would be just by NEO going up, right? Unless there's a stock that's paying out a dividend, then you're making money that way too. But in this case, if I was just to simply buy NEO, then I would just simply be down $66. But because I collected the $30 and bought the option back, in total I made about $20. So technically I'm down only like $47. The market is open, so this is going to fluctuate right now. And right now we can turn around and sell some covered calls. Now NEO is a very cheap stock, like I said. I don't really invest that much money. It's just a little tiny small position, but this is what I like to call little paychecks. I collect these little premiums on stocks like this and slowly but surely grow my account, and I sell them at the money with the intention of getting assigned. Collecting that premium, get in and out, and rinse and repeat. So now let's collect some more premium. Now we have 300 shares available to sell some covered calls, and we're gonna do them for 1 month. Okay, so we'll do where is it? January. Yeah, we'll do January 10th. Okay, and I'm okay with that. Like I said, you got to be okay with taking the profits right away if your stocks get assigned to sell at that price. Now for January 10th, we're going to collect anything between $20 and $23 right now. So because we have 300 shares, we can do 3 contracts. Remember, it's 100 shares per contract. So we're going to sell covered calls. And we're going to go ahead and, we'll try to get 21, see if they give us 21. Confirm and send. So we're going to sell 3 contracts. We're going to get credited $63 right now, minus the option, the cost of the trade for the option. So $61.05. Go ahead and send it. There you go. We just got $61 credited into our account. Now what happens next? If NEO by next month reaches anything above $2.50, then we're going to have to sell NEO at $2.50. So we're going to make basically break even almost, because we bought them at $2.51. We're going to lose like $1, but it's kind of like the break even price. But we collected those $61 for the premium. So we're basically, what I'm doing with NEO is basically buying it back, buying it and selling it back at the same price, but I'm, taking some profits for the premium. Now I do it at the money with NEO because, again, my intention with NEO is to sell them right away, get assigned. That's what I'm trying to do. Just collect the premium, get assigned, get in and get out. I'm not looking to sell out of the money because it's a penny stock. It's very cheap. Anything can happen. That's why you gotta know the risk, how much money you want to invest into a stock. Now I'm just doing it on NEO with this many shares right now. But again, it's just a few dollars here and there. Doesn't hurt, right? So I'm okay with collecting that much premium and doing that on NEO. Now again, that's just my strategy. Now I'm gonna show you another one. Ford. Ford is another one that's very cheap, but I think there's some upside potential for Ford in the longer term. Now Ford, I currently only have 600 shares, and I do tend to sell puts on Ford. Just sell puts and then covered calls again. Now Ford, again, it doesn't really have those big moves where it moves like $1 or $2 or $3 a day. If you've been following Ford, it moves very little. So that's why I tend to do at the money covered calls with Ford as well. Now with Ford, I already sold some covered calls. I have the average price of $8.89, and I have 600 shares. Now if you had 100 shares, then you can still do it, of course, but the premium, the premium is not going to be as much. But again, we're talking about growing a small account slowly but surely. Now, if you like Ford and you wanted to be in Ford for the longer term, it has a healthy dividend. And me personally, I believe there's some, upside potential to it in the longer term again. So yesterday, I'm going to show you what I did. These contracts expire tomorrow, by the way. So because I have 600 shares, the premium is really not that much again. So yesterday, I sold some covered calls. I sold 6 of them. Then I got $4 for them. So 6 times 4 is 24. So I collected $24 yesterday to give somebody the right, but not the obligation, to buy my shares at $9. That is the strike price. So if Ford by tomorrow reaches anything above $9, then my shares would be taken away at $9 if I get assigned. Now, because I bought them at $8.89, I would make the capital gains plus the $24 that I collected. The $24 is already in my account. Remember, the premium is already credited into your account instantly. So that's what happens tomorrow if Ford, goes above anything above $9 and I get assigned. I still make money. Now, if Ford just stays around this same price by tomorrow, by Friday, then I basically just made $24 for simply holding a stock that's already in my portfolio that I like. That's the power of covered calls. Now, what happens if Ford goes a little bit further down? Again, the risk when you're buying into a stock is that you're going to have your red days, your green days, and your days where it doesn't really do anything. So if the price of Ford goes down, then basically the options are going to expire worthless. I still made the $24, and I'm going to be down on Ford. So what happens next? Then I can turn around and do some more covered calls for the following month. And that's how you roll it over. You keep doing covered calls. You're collecting premium while you're holding the stock. They're little paychecks. Again, $24 is not a lot. You're going to say it's not a lot. But also, so is your investment. Your investment is not a lot too. Now, when you start investing more and then getting into these stocks that have more premium, that are more expensive, then you start seeing a lot more money. I'll give you another example on the ones that I've been doing them on too, that are a little bit more expensive. Now on AMD. Now on AMD I did get assigned before. I've been doing it on AMD for quite a while now. If you watch my other videos, currently I have 200 shares. I have them at an average price of $39.67. And I'm actually up right now. I was down, like a few hundred. The other day that was 39.65. No, I remember being down a few hundred. That was probably on the other video. But anyway, I sold some covered calls. I'll show you right now. For the next month, I collected $103. Obviously, because the price of AMD has gone up, these contracts get a lot more expensive. So now if I wanted to get out of the contract, I would have to pay more for the contract. Now, at the moment, I'm okay with selling AMD at $40 if I get assigned. I collected $103. See, now we're not talking about like $24 or $30. We're talking about a little bit more. That's just on one contract. And I have another contract where I got paid $262 for February. And so a total of $365 that I collected on those contracts. And plus the capital gains that I would make. So a little over $400 is what I would make with these covered calls. See, now you're talking about more money now. Now with, there's another one that I've been doing it on too. Wind resorts. I'm actually down on it. I'm down $511. But I was kind of waiting for it to go up just a little bit more to get more premium on the contract. But if you notice, Win is one of the one that has. I have one contract right now actually open on it, but I gotta buy that contract back if it goes down in price. Try to buy it for cheaper and then turn around and sell another covered call contract, basically another covered call. So basically with the covered calls, and I'm going to show you, so let's say for the monthly covered calls on Win, see now they start looking juicier because the price of the stock, obviously it's more expensive, on stocks that have volume and a little bit more popular, you're going to have a lot more premium. And again, you're going to be okay with holding the stock for the longer term. So again, this is what happens. If you're okay with holding it and you're down, I don't care. I'm collecting premium in the meantime. I'm down $516, but I was actually down almost $800 and something like 2 days ago. So that was a lot. Now it's kind of recovering. But in the meantime, I'm collecting premium. So if you were to do a covered call for this, let's say we'll do it next month, January. Now you're looking at, at $4.55, $5.05. So technically, because it's 100 shares, this is $505, $455. Now you're talking about more money now. So this is how you kind of grow your account slowly but surely, in my opinion, in a safer way, is the covered call and selling puts. Now, when you're selling a put, I haven't even talked about selling puts yet. Now, I'll give you an example on Ford, because I do it a lot on Ford too. So let's say my shares get taken away at $9 tomorrow, right? So now I have that capital untied. I sold my shares at $9, made some profit on the capital gains, and made some profit on the premium. Now, what I would do, basically, if that happens, then I would go to next month, let's say the 10th of January, I would sell some put options at $8.50. And for those, I would get paid anything between $10, 11 cents, of course, depending what the price of the stock is tomorrow or Monday, actually. And I would sell some puts. I would put my money as collateral now. And then I would get, per contract, anything between $10, $11. Again, depends what the price of the stock is on Monday, and collect some premium. And then if the price of the stock starts going up, then these contracts become very cheap because it's further away from the $8.50. So the probability of me getting assigned is, very minimal. So that's why the contracts become cheaper. When you're selling a put, the price goes high, I can buy these contracts back for maybe $2 to $3, keeping the difference. And now, let's say Ford goes to $9.50. Now I can sell a put for $9. Now you collect more premium again. So you keep collecting premium until you get assigned to buy the shares. Now, again, you got to do the put options on stocks that you're willing to hold, because the only way you're going to get assigned when you're selling a put is if the price of the stock falls below the strike price. So if I sold the puts for $8.50 and Ford goes to, let's say, $8.20, I still have to buy them back. I still have to buy them at $8.50. Again, you're gonna think, so why would you overpay? Well, that's a risk that you're taking when you're selling a put, but you're getting paid premium credited into your account for taking on that risk. But then again, it's a stock that's currently trending higher and that you're willing to hold for the longer term. And you turn around, you sell a covered call, you get assigned, then you turn around, you sell a put, collect some premium, you get assigned. It's all rinse and repeat. And the great thing about this is because you own the stock when you're selling a covered call, there's really no expiration date for you because you have the stock. There's an expiration date for the buyer. So that's a good thing about the covered calls. Now, when you're buying options, when you're the buyer of the option, you have an expiration date for that price of the stock to move. If it does not move in your favor, you're going to lose money by having to either sell the contract back, or that contract is going to expire worthless, and everything that you invested to buy that contract, that option, basically that call option, you're going to lose. Now, if you do it on stocks that move between $3 to $4 to $5 a day, that's a lot of money that goes down the drain if the trade goes against you. Now, I've made some money by buying call options before, but I don't tend to do it as much because I know the risks, and I rather take the safer side of the trade again. Now, again, I just wanted to share this video on little trades that I do here and there. Doesn't necessarily have to be big trades. You can take little crumbs, just like one of my fellow traders says. What's his name? John from Options Trading, Core Options Trading, something like that. I watch his channel sometimes, and he has a very good strategy with selling covered calls and selling puts. And in my opinion, it's a great way if you want to grow your account slowly but surely. Again, thank you very much for watching, guys. And if you guys have any questions, comments, leave them down below. I'll be more than happy to answer. Again, thank you very much for your support, your likes, your comments, and I hope to hear from you guys soon in the comments section. Until then, I'll see you guys on the next video.